What's up, guys? It's your boy, Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of GNUS Brands, ticker symbol GNUS, trading for $1.68 as of July 29th, 2020, equating to a market cap of $362 million. No one can argue that it's been a crazy ride for GNUS investors. I mean, not only is the company up 380% in the last 6 months, but on the other hand, down nearly 80% from its highs seen early last month. And I can imagine many of you guys thinking to yourself that that's absolutely bonkers. Well, pump the brakes, boys. When we scroll out, this insane movement is just a blimp since its IPO, where the company was trading for $240, representing well over a 99% decrease in share price. So what's the move? Is GNUS Brand a 200 IQ move? Or just child's play? This is your quick stock analysis. With the insane volatility, there's going to be a lot to unpack in this video, so let's get right into it. GNUS Brands is a network program who creates licensed animated content intended for toddlers and tweens. It only feels right to take a look at why the company has had such a massive rally leading to a sharp correction, and then we will get into your quick stock future projection for GNUS Brand. So of course, a majority of the run-up was due to GNUS Brands announcing the launch of its own network channel, being the Cartoon Channel. You can access the Cartoon Channel on some of consumers' favorite platforms such as Roku, Amazon Fire, Apple TV, Android, Chromecast, YouTube, Prime Video, and so on. I know a lot of y'all want me just to get right into the numbers, but honestly, I don't think a lot of people realize what they're getting when becoming a shareholder in GNUS Brands. Speaking on their content, I checked out their app and YouTube channel, and take it as a grain of salt as clearly I'm not their designated audience, but the company produces decent animation that has a proper story or lesson, which I think parents can appreciate, as in the last decade, children's cartoons really has taken, let's call it a weird turn. Anyways, I did notice some red flags regarding their YouTube channel. 3 years ago, the channel was putting out content that was consistently getting 100,000 views, which, honestly, considering the cost of animation, I kinda doubt it was ever profitable. But since they dropped their Space Pop series about 3 years ago, the interest is almost non-existent. Seriously, check this out. In the last 2 years, the company is consistently getting around 1,000 views, which is certainly nothing to write home about. And regarding the network name, I gotta note autocorrect is going to steal a decent portion of the company's users. In all honesty, it almost got me. When trying to download the app from the App Store, it corrected the K to a C, and the first app to come up on the App Store was Cartoon Network's app, which you really don't want autocorrect taking consumers to your competitor's site. But in the grand scheme of things, it's pretty trivial. Anyways, the app's alright. Nothing to write home about, but simple enough for a child to use. And remember, after all, it was completely free for me, which I really gotta wonder how the company is going to make money. On the 3 videos that I clicked on, I didn't get a single ad, and I gotta note, the lack of ability to cast to a TV or computer is pretty disappointing for a streaming service. I mean, a basic consumer grade, $300 NAS or network attached storage device from Synology offers a better server platform than this once billion-dollar company does. But we are probably being too overly critical. After all, this is a children's streaming service. But it leads us into our next point. When looking at the streaming market, one should remember Hulu, Disney Plus, and if you disregard the last year, even Netflix aren't profitable yet. Granted, yes, they could turn on the faucet at any point and focus on profit rather than growth, and easily become profitable. All we are trying to say is it really does shine a light on the difficulty of becoming profitable in the streaming game. So now that we've overanalyzed the company's streaming service, let's rack up some more dislikes and take a look at the company's balance sheet. As of March 20th, GNUS Brand's cash to debt ratio was 0.43. As you can see, the company's net income has been down massively besides a small blimp in 2017. A third of the company's assets are in the form of their characters, which, unless another company buys them, they don't have any tangible value. And while looking at the numbers, we gotta note the company's Q1 2020 earnings came out May 18th, where the total revenue dropped 72% year over year, from $1.2 million to $334,000, while losses were $1.25 million to $1.77 million. And the worst part is, the poor performance was blamed on Genius Brands' television and home entertainment segment, which fell from $850 million to $52 million year over year. However, Genius plans to reverse this with the release of its new cartoon channel, which we just talked about. However, keep in mind the Q1 2020 earnings were as of March 31st. If you can take yourself back to March, this is, at least in the United States, when quarantine restrictions started. With stay-at-home orders in place elapsing during the company's next quarter, one could assume a large increase in users, which, keep in mind, at least on YouTube, we didn't see. But it does offer a catalyst for the company. And companies like Netflix's active users went bonkers. So what we're trying to say is investors really have to be banking on next quarter's earnings, which is August 17th, 2020. Really, this is going to be the company's chance to prove itself. And I mean really, what's the outcome if the company does have yet another disappointing quarter? The stock goes to under $1? Which, I'm calling it now, you're going to start seeing articles about Genius Brand getting delisted. But what's actually going to happen is the company is going to hit 92 cents, and the company's going to do a reverse stock split of like 5-to-1. Remember, a lot of the hype around the company is due to the company's share price being so cheap, and I think the company wants to keep it that way while remaining above the threat of being delisted. However, along with this, the company is going to offer yet another public offering that will take place throughout the year, and the company will drop another 20%. That's your Quick Stock bear case for Genius Brands. Disclaimer, Quick Stocks is not a financial advisor. I am your simple Quick Stocks reporter for educational use only. Here at Quick Stocks, we must insist that no one attempts to recreate or reenact any trades or theories seen or given on the show. Now that half of y'all are salty, let's get these fries dripping and cover the bull case for Genius Brands. Let's do this Quick Stock style. Some bullish analysts have a price target of $8, which represents over a 400% upside. Let's be real, it only takes one massive hit. I mean, Nickelodeon is still riding the SpongeBob train 20 years later, including
Arnold Schwarzenegger,
who will voice in Stan Lee's superhero Kindergarten, and received warrants to buy Genius Brand stock, who, let's be real, he'd be a fool not to. I'm sure he's paying pennies on the dollar per share. Don't get me wrong, it's great to have a big name backing the company, but I wouldn't look into it too much. And speaking of, Stan Lee's superhero Kindergarten. It was a result of a deal between Genius Brands and Stan Lee Universe, giving Genius Brands the right to use lesser-known Stan Lee original characters such as Lucky Man, Alter Ego, and Zip. Of course, nothing from the Marvel Universe, which is owned by Disney. The only problem with this deal is Genius Brands does not own rights to any of these characters. So in theory, Genius Brands could do the legwork and build out one of these unknown heroes, only for Stan Lee Universe to sell those rights to, say, Disney. Along with this, some investors are convinced that Nickelodeon, Disney, or Netflix are going to buy out the company, which certainly is feasible because brands such as Nickelodeon already air some of Genius Brands' titles, such as Rainbow Rangers on Nick Jr., or maybe Amazon or Apple, as the companies already have contracts together. Long story short, certainly a buyout is possible. However, with Genius Brands trying to direction towards online streaming, I'm not sure how this would benefit these larger companies, as most of them already have an established platform. And I certainly can't imagine one of these other networks wanting to piggyback off of Genius Brands platforms to create their own streaming service. In all honesty, it would be easier to start from scratch without inheriting Genius Brands' liability. Another double-edged sword is, well, one could argue with all the extra cash the company has been able to raise by selling off more shares, investors should expect higher quality content, hopefully attracting a larger audience. And finally, the last catalyst for the company I'll note is its toy deal. The company's got some outstanding deals with companies such as Mattel, which will help debut Rainbow Rangers in Walmart stores, along with face masks and bikes. Many investors hope this is just the beginning. So with all of this in mind, what's our move? I'm gonna make this quick and I'll be blunt. We have no interest in starting a position in Genius Brands. I'm not saying the company doesn't have the potential to pop as more news comes out. After all, it is a hype company and trades as such. It's just honestly, the risk far outweighs any of the positives that the company could offer us in our long-term quick stock portfolio. But if I had to buy shares, it would be for around the $1 range. Take it for what it is. Realistically, the company's next earnings is the company's chance to prove itself. But if I had to buy shares, it would be for around the $1 range. Take it for what it is. Realistically, the company's next earnings is the company's chance to prove itself, and I don't want to make an investment on such a shaky foundation. And remember, we've already got a decent sized position of over $10,000 in Disney, which gives us plenty of exposure into the children's streaming market. Anyways, guys, that's all we've got for today. As always, the best investment you can make is to go long on Quake stocks. Hit that subscribe button now at 905 subscribers and plan an early retirement. I will catch you guys in the next one.